Now let's talk quickly about the dollar. You can see that between 2006 and March of 2008, the dollar fell. Actually, the dollar's been falling for about 20 years now. This is called beggar thy neighbor. This is the way inflation gets sent because the dollar, most commodities are valued in dollars. And so we've lived, you and I, and all of us, we've basically lived along this curve. You with me? In March, the OECD, not quite knowing what they were doing, met in Japan. It was March the 13th, actually. This was when we had a 75 basis point cut in the Fed funds rate, and the dollar went up. And I said, wait a minute, what's going on here? How can you cut rates and the dollar goes up? And well, because they were out to rescue the dollar. But the dollar bottomed, at 71.61, went along for a while. On July the 13th, the OECD had opted for a rescue. This is well documented. It's in the press. In March, the dollar was too cheap. Secretary Paulson accommodated on Sunday, July the 13th. I remember it well. I was in Dallas, Texas, and Goldcorp was trading at $52, and it fell to $14 over the next few months. And I'm not kidding. It's at 20 now. Paulson accommodated on Sunday, July the 13th, before the markets opened in Asia. He defended Fannie and Freddie. Basically said he didn't exactly use the guarantee word, but he implied it. Now the bank stocks had been falling. This was causing concern because the banks were having to raise capital in this country because of their write-downs. And so basically, literally, the next day, we saw the dollar, the short dollar position. Why was the short dollar position in play? Because the dollar was so cheap, everybody was borrowing it to buy everything. And there are two kinds of carry trades. The yen carry trade is one in which Japanese borrow in their country and invest in other countries. And the reverse carry trade is where the Brazilians borrow US dollars and invest in their country. So US dollars had been borrowed, yen had been borrowed, any low interest rate currency had been borrowed, and all of a sudden they had to be covered. And so you have here a very significant increase. I thought at 80 we were done, but I was wrong. And so on September the 13th is the day. You can go back and look at all the stuff in the FT and the New York Times and Washington. You'll see all this stuff as how it played out. I think the mistake they made was they did not realize how much debt, how much short covering of the dollar was going to have to take place. And if you, Monday morning, if you go to Kitco and you just scan in to the gold page and look down, and you look at the currencies, like on Friday, the Canadian currency fell by 2%, the Australian currency, so they're still liquidating. As we speak, they're liquidating. And so the dollar's going to get stronger, and that was pointed out in the luncheon. The dollar's going to get stronger until it decides it's not going to get stronger. It'll get stronger as long as there's debt liquidation. The carry trades have to be reversed. Nobody knows when that is. So don't short the dollar just yet. Wait until we get, when the Chinese announced their program, their $586 billion program, last Monday was it? Last Monday. Commodities soared and the dollar fell, and then the next day gold. So there's still liquidation. I think either Mr. Hale or one of the panelists talked about the fact that the margin clerks are in control. The margin clerks are in control. And it's not the bad assets that get liquidated. It's the assets that can be sold that get liquidated. Like oil and copper, you name it. And those are the ones that are sold. And Goldcorp, it puts a pain in my heart when I think about that. But here's the real problem. This is a big problem. Japan's strong yen is a big problem. Why? Because Japan's economy is the second largest economy in the world, and it is export based. And a strong yen isn't a good thing. Strong yen is not a good thing. In fact, the Japanese have said, we need a rescue, we need a rescue. And so they got permission from the G7, or G8 I think it was, to be able to go in and try and rescue their own currency. But the fact is, it's very difficult to do a currency rescue. So you can see here the yen is still extraordinarily strong. And this will shut the Japanese economy down. This could shut the Japanese economy down. So where are we? Where are we in this mess? I know you're probably ready to slit your wrist. You know, what a way to go home, right? I don't want to listen to this guy again. Bretton Woods 2. This is a great article by James Grant. Anybody know about Grant's interest rate observer? It's called After the Crash, Helping the U.S. Economy Right Itself. It's the most sensible thing I've seen, and yet we're not going to do it, unfortunately. The truth is, he says, the current mess is a symptom of persistent financial derangement, in particular a sickness of the dollar. He lays this mess at the dollar, you know, with the decline of the dollar, the manipulation of the dollar, because it's a fiat currency, because it's not tied to anything of value except the whim of the Federal Reserve. You can believe that or not. Over the past 20 years, rational markets have gone off the deep end many times. LTCM, crash of '87, and so on, they go down the list. The Federal Reserve has intervened with lower interest rates and a faster pace of printing money, which has ignited a new speculative upswing. And so you might ask, well, what's the next speculative upswing? If it works, the next bubble that's ready to burst is the Treasury market. If it works, if you pull out of this. What might an ambitious, he says, I love this, what might an ambitious president do besides no harm? He could plan for a return to a sound dollar. Indeed, it is his duty. The golden anchor of Bretton Woods served two purposes. It checked the tendency of hegemonic power to live off the cuff, as the U.S. is living grandly today. Everybody in this room knows exactly what I'm talking about. And it fixed the dollar's value against other leading currencies, so that you don't get a day like October the 6th, where you get the tremendous swings in value that change everything in the real economy. The new administration, Congress, and the Federal Reserve must stand up for the dollar abroad as well as at home. Fixed exchange rate and a gold or commodity-based currency for the reserve currency. He didn't say the dollar, he said for the reserve currency is a worthy solution. Well, this is what the banks look like today. This is as of Thursday, and this was Paulson's ploy. July the 13th, he did rescue the banks, but the ploy has not worked. As you can see, the bank stocks have fallen, and so a lot of people will say to me, well, should we buy the banks? I hear them on CNBC all the time. I wouldn't touch a bank stock now until we see some clarity, the fog of war has to clear, the fog of this economic war. But here are some interesting things. By November the 5th, the U.S. pension plans had become underfunded by $100 billion in a short period of a year. U.S. pension plans had become underfunded by $100 billion. Citigroup had fallen from $50.96 to $9.50, an 81% decline. GM had fallen from $41.39 to $3. It's actually $3.01 right now, a 92% decline. And GE had fallen from $40.50 to $16.05. GE, a 61%. They're just three examples. Now, you can argue that they all have financial exposure, and in fact they do. But there are lots of companies around like that. So we do have a pension gap staring us in the face, which said I'm 61 and I'd like to retire in a few years, and that also hurts me. Gold has held up very well. Not as well as we would have hoped, but it hasn't fallen on its sword. It has not. Downside, probably 600. Upside, gold's going to go to $2,000 at some point in the future. Please consider a small allocation to gold in your portfolio.